Right. Welcome, everyone. Good morning. We can go ahead and put up the chat. Let people drop a comment when they tune in. I see some people are already in there talking before we let it live. Thank you for tuning in. As always, we'll wait just a few minutes here to wait to go live on all the different platforms. Let everybody jump on. Good morning, Elisa. Happy Friday Eve. I haven't heard that. That's prematurely celebrating the happy Friday, huh? I guess you're ready for this week to be over, huh, Lisa? That's what that sounds like. Let's see. Good morning, Christina. Good morning, everybody checking in. We're just waiting a couple minutes here to go live everywhere. Let's see. There we go. Good morning. Good morning. Shout out to the Mortgage Calculator team tuning in. All right, just a couple more seconds. We're just waiting to go live on all the different platforms, and then we will get into it here. Feel free to drop a comment there to check in for everybody tuning in. Appreciate you tuning in from the beginning. All right. Looks like we are live on all platforms, so we can go ahead and get started then. We'll go ahead and move the chat out of here. But go ahead and keep dropping comments in the chat as you check in. But good morning, everyone. My name is Kyle Hiersche. I am the COO of the Mortgage Calculator, joined here by our president, Nick Hiersche, and our sales manager, Jose Gonzalez. Thank you for tuning in for another edition of Daily Mortgage Rates Live with the Mortgage Calculator. So what we do every morning is go through the rates for the different programs, the actual live rates for today. That way you can tune in every day and see how the rates fluctuate and go up and down and how the market is going. And then we do a deep dive into a different topic every day, a different type of loan. And today is a very fun one. Today we're going to go into fix and flip loans. So Jose actually has a quote pulled up for a fix and flip loan, and we'll go into more detail about that at the Mortgage Calculator. This is definitely a special, common product that we have because we deal with so many investors. So we do a lot of fix and flip loans. Definitely exciting, but definitely a tricky loan to do. So Jose will talk a little bit more about the ins and outs of that later. But for now, let's go ahead and do what we do every morning, which is pull up the pricer, and Nick will go ahead and go through some different scenarios and check out the live rates for this morning. So go ahead and take it away, Nick.
All right, thank you, sir. Let me go ahead and switch my screens and we'll get started. So this is our pricing tool for our team of loan officers. We have over 350 loan officers. We're licensed in 22 states for primary and second homes. And we can do our business purpose DSCR loans for our investors and our fix and flip loans, like we're going to go over here in a minute, in pretty much all states, except about 6, I believe, that are not able to. So please get with our team. If you'd like a full loan estimate, this is our pricing tool. It's just going to indicate the rates for today. It is March 2nd, just after 11 a.m. Eastern. So all of our standard programs have the rates issued for today. Again, if you want a full breakdown on a full loan estimate, please get with our team and they'll be happy to send that over. For now, we will pull up some basic scenarios. So for everything we do today, we're going to do an 80% loan to value, 20% down payment. We're going to keep the loan out set at $400,000, a nice regular amount there. We're going to keep our desired price at 99. What that means is for all of our scenarios today, we're going to try to have the computer find the best rate at a 1 discount point in cost. Most of our borrowers are asking to buy down the rate a little bit, so that's typically what we do today. We're going to go through some scenarios. We're going to do our conforming conventional first. Then we'll go over our FHA options as we do every morning. And then our expanded guidelines non-QM. We have over 4,500 programs here at the Mortgage Calculator under this umbrella of non-QM using alternative income documentation. So that's what we love to do here as well. We can obviously quote VA and USDA, but we won't do that live here today. VA is just for our eligible veterans. We appreciate you. We can quote that in a few minutes if you are shopping out there. We'd love to quote that. And if you're looking for a USDA property, remember those are only in USDA eligible areas. So if you happen to be looking in one of those areas, not everybody is, please let us know and we'll quote that up. But we'll keep it to our standard scenarios for the show today. And we'll start with our conforming conventional. We're going to keep everything as a purchase, 30-year fixed loan, pretty standard. We're going to do primary first, single family, 1 unit, state of Florida, county Miami-Dade, that's where our office is based. Estimated FICO for all our scenarios today will be 760, and an estimated debt to income ratio for all of our scenarios today will be 40. So let's check out what our rates are this morning. Let me get through the security. And looks like rates have gone up since the last couple shows, unfortunately. So we love to do this show to watch as it goes up and down. Hopefully we see some downward movement soon. But today looks like, let's see if there's a better combination here. Yeah, a couple better options here. So 7.125 rate for 0.75 in discount point cost. So a little bit higher. We saw it in the high sixes the last few days. Obviously the markets are reacting to a lot of the inflation type data, but we would still love to quote these for you guys. But I think the attractive option here is going to be our non-QM, which we'll get into in a second, especially as conventional continues to fluctuate with the market activity. We see non-QM stay nice and steady as our Wall Street type investors that set the pricing for non-QM still have an appetite for loans and don't really fluctuate as much. So that will be a great point to compare. The next option we usually go to, though, for most banks, lenders, and customers, of course, if a customer doesn't qualify for conventional conforming, typically the next option we go to is FHA. It affords us a little more leniency on the debt to income ratios, a little higher options there, and a little bit more leniency on some of the credit items. So typically that's our next option. So we'll keep everything else the same, purchase 30-year fixed, primary, everything else is going to stay the same. And let's compare our FHA rates this morning. Remember the FHA upfront mortgage insurance premium just last week got announced that they're going to be dropping it. So these prices you see here, the APR is actually going to go down slightly as the new MIP values get set. So FHA definitely showing some promise for our borrowers out there, especially as you can see the rates are a little bit better. So the best combination the computer found here, 6.125 rate for 1 discount point in cost. And just keep in mind FHA has upfront and monthly mortgage insurance. So always compare the APR so you can compare apples to apples, comparing the FHA to any other loan. Now, there's a ton of options here for FHA that are kind of specialty. So you see some weird stuff showing up here. But we'd love to quote any of the special stuff as well that you guys have. If you have 2 or 3Ks, anything like that, we have access to all those great programs. But for our borrowers who do not qualify for enough home or enough payment, using our conforming or FHA guidelines, many lenders do not have another outlet. But fortunately, here at the Mortgage Calculator, we have over 4,500 loan programs under non-QM, aka expanded guidelines, which allow us to qualify our borrowers where they would not otherwise qualify, or use alternative income to qualify for more than they would normally qualify with their full documentation income. So we'll keep everything else the same here, except you see one new option pops up when we go to non-QM, and that is our income verification option. So here we can do full doc, which is obviously 2-year tax return, just like all the conventional and the FHA options. But we have tons of other options as well. 1-year alt doc, 2-year alt doc, asset related. We did a show earlier this week on that. Please check out that show if you want to see some asset-based programs. We have our business bank statement programs, our investor programs for investment properties. And here's our most popular program by far for non-QM for a primary home purchase. Is typically going to be our personal bank statement 12-month program for our self-employed borrowers. So instead of using 2 years of tax return income for our self-employed borrowers, where they may have various write-offs that affect their qualifications, we're actually going to use 12 bank statements, the last 12 months of bank statements, to actually determine a debt-to-income ratio for that self-employed borrower using these alternative income documentation. And therefore, we typically able to qualify the borrower for much more purchase power, much more payment that they can afford, and therefore purchase the home that they're looking for. So these are great solutions for our borrowers who would not otherwise qualify for either as much or qualify even at all in some cases. So we love these options to provide solutions. And now let's check out what we're looking at. So as I mentioned, the conventional rates are going higher, whereas these alternative documentation rates, the bank statement programs and all these other non-QM programs, are staying relatively the same. So usually we see them a little bit higher. You see one of the options here at 7.75 for 0.625 in cost. Very comparable now to a conventional loan. You saw the conventional loan was just in the low sevens for similar cost. So very, very comparable. I love doing this show every day. Even though, conventional is going up, nobody likes to see rates go up. But what we love to see is the comparison of as conventional goes up and non-QM stays the same. Now these are much more viable options for our borrowers. Let's scroll down here. I bet there's possibly a better option. You see there's dozens of programs. Aha. So this one is usually our best option. 7.125 rate for 0.875 discount points. So this is almost apples to apples. If you look at the APR on the conventional, we're right there now. And that's amazing, right? We love when our non-QM is not only comparable, but almost identical in this case to our conventional rates for our borrowers, which again, still allows us to use alternative income documentation, qualify for more home, etc., and really provide a solution for our borrowers who may otherwise be stuck or not be able to afford as much home as they are looking for. So we love these options. Notice if we scroll down here, there's just dozens and dozens of options using bank statements. Please get with our team so they can navigate which one of these works exactly best for your situation. Some of these programs may allow things like credit events like foreclosure, etc. So please get with our team. Those would be some of the higher rate options, obviously with the specialty, flexible credit, etc. So tons of options. We love to provide these solutions for our borrowers. Now, before we go into Jose's deep dive, we always want to go back and show our options for investment properties. So we love to work with our investors, whether they're a first-time investor or they have, a portfolio of hundreds of properties. We particularly specialize in investment properties here and investors. So let's pull up a pretty common scenario here for a investment rental property purchase. We're going to do 80% loan to value, just like we did before, 20% down payment. We're going to set it up as a purchase. Everything else is going to be the same. And we're going to compare our two investment property options. We have conforming conventional options, which are going to be a little bit spendy, but we also have our expanded guidelines non-QM options, including our DSCR, which is our most popular program by far. So we love to go through these different options and compare them side by side for our investment properties. So let's check out our conforming. Everything else will stay the same. This is going to be for our borrowers that qualify using full doc for a conventional loan for investment property. Now you'll notice the computer is not able to find any options for one discount point in cost. That is because there are additional loan level price adjustments that Fannie Mae and Freddie Mac have added to their programs. Those are the GSEs that run these programs. And unfortunately, we don't really have a choice. We cannot find an option with one discount point in cost. So even though some investors ask to go higher in the rate here in order to reduce these discount points, most of these programs are pretty limited on how high of the rate we can go in order to reduce those costs. So here we'll see pretty much this 7.375 rate with 3.25, probably one of the best combos that the computer found. Sometimes our investors want to go up in rate. Let's see if there's a better option with some lower discount points. And unfortunately, it looks like that's probably about the best option here. 7.49 rate will go down to 3 discount points in cost, but obviously nothing in the 1 range. So our investors are often asking for other options, right? Our investors want to save discount points so they can use that cash out of pocket to purchase more rental properties. So our solution to that and our specialty here at the Mortgage Calculator is going to be our non-QM. So let me set this up for our final demo scenario for today. Investment property, expanded guidelines, aka non-QM. Now we're going to have 2 different options. Our first option is our income verification. And for our investment properties, non-owner occupied, we're going to use our DSCR income documentation. And that's because our most popular program by far, because it does not require any income documentation from our borrowers. No employment and no income documentation from our borrower. We're simply going to use the estimated rental income from the rental property. in order to determine if that rental income can cover the PITIA, the expenses, the mortgage payment of the property, the housing expense, right? So as long as it covers, typically that's a 1 ratio. We have tons of options for a 1 or greater ratio. We even have options for a DSCR loan that doesn't quite cash flow for a lower than 1 ratio down to 0.75 and even no ratio options. So tons of different options here that pop up under DSCR, which is why we love these programs. And the other thing that pops up under all of our non-QM investment properties, they're always going to have a prepayment penalty, pretty standard. We obviously can select 0 prepayment. That's going to limit our loan options. So for our demo today, we won't do that. But if you're very set on no prepayment, we can do that for you. 3 years is pretty standard. So that's what we'll use for today's scenario. And 5 years is always an option. That does limit your loan programs a little bit, but does save on the cost if you're going to hold a property. But let's do a standard 3-year. That's typically what most of these are priced at. And let's check out our DSCR rates this morning. So again, when we compare this to conventional, obviously it's a little bit higher rate here. One of the best options I found was 8.625 for 0.975 in discount points. So a little bit higher rate, but our investors are saving money out of pocket on discount points. We have tons of options for under 1 discount point because on DSCR, we can go up and down in rate much easier than on the conventional programs. So let's scroll down here. You see we have dozens of DSCR programs that vary in the DSCR value and the prepayment penalty, etc. So please get with our team. They'll navigate which one of these works best for your situation. But I always want to scroll down here. There's obviously a specialty program that's usually our best price, and it is. This is the best one if the property cash flows very high. We have an 8.25 rate available for 0.6 in discount points. So that's an amazing program. Again, it depends on if the property qualifies. Please get with our team. They'll do a quick analysis on the DSCR, as you can watch in our weekly DSCR show, how we do that analysis. But our team is trained to do that. They'll figure out which one of these programs fits best for your scenario and your purchase and find the best option for you. So that is it for our live rates today. Let me go ahead and switch my screen and we'll get into Jose's live demo with some detailed rates. So let me pull up this real quick. So we're going to talk today with Jose about fix and flip investor loans. As Kyle mentioned before we started, I know a lot more people tuned in now. The fix and flip product is a very popular product for us here at the Mortgage Calculator. We work with a lot of investors that are looking to, buy, sell, get into real estate, move in and out of projects. And obviously the fix and flip is the great vehicle for anything that has condition issues, right? So remember, as a standard program for our team out there, remember condition C4 is typically the worst we can do. Anything worse than C4, we're going to be stuck with a fix and flip type of product or a renovation type of product. If it's a primary home, obviously, right? If there's issues with the property, we're not going to be able to do a standard DSCR loan. So we're typically going to have to solve those issues with some sort of fix and flip product to repair those issues so that we can get a clean appraisal. And then we can do a long-term DSCR loan for our investors once the property is fixed and flipped. Or, of course, the investor could sell the property once it's fixed and flipped, which is typically what fix and flip means, right? So let's take it back to what does fix and flip actually mean. So before Jose starts, I just want to go over fix and flip is simply a bridge loan, right? It's a short-term bridge loan with rehab, right? So we have bridge loans with no rehab. A lot of times investors will do a bridge loan because we don't require the condition. It's not a long-term loan. We allow them to make the repairs on their own, out of their own pocket with a bridge loan. Or we'll have what is typically known as a fix and flip loan, which would be a short-term bridge loan with a rehab element, right? And then we also have our ground up, which we did a show on a couple of weeks ago, which would be a land purchase with a complete build from the ground up. So a couple different kind of variations there. They're all kind of variations of bridge. So I want to make sure everybody understands this is under the bridge umbrella, but fix and flip is a very specific kind of niche of the bridge. But there's always bridge where you can pay rehab out of pocket or bridge with rehab, which is exactly what we're talking about here. So hopefully that prefaces it good for you there, Jose. But you can go ahead and take over and get started. Thank you.
Good morning, everybody. Thank you for joining us for Daily Mortgage Rates Live with the Mortgage Calculator. Jose Gonzalez here, sales manager, licensed in September 1997. Both real estate and mortgages. Actually obtained both licenses within 3 days of each other. So it's really interesting that we're covering this topic today, and interesting how Nick was talking about maximum C4, and if not, then you got to do fix and flip, because that's the beauty of being at the Mortgage Calculator, is all the solutions that we have. Because we recently had an MLO that had a deal that went out to be appraised. And the appraiser called us back and said, hey, this property is in C5 condition. What do you want us to do? Well, luckily at the Mortgage Calculator, we have solutions. It wasn't like, oh, deal is dead, deny, and let's, lament that we lost that deal to condition. No, we just transitioned the deal from the type of traditional loan. It was an investment property loan. I think it was DSCR on top of that. We transitioned that to a bridge loan, fixed flip with rehab, and just reordered the appraisal as an ARV appraisal after repaired value, where they take into consideration the as-is value of the property, the rehab component, and what will be the value of the property after the rehab is complete. You're supposed to be adding value, not dollar per dollar, but like exponentially. So in this case, we have a deal. It's still going on, and that's just one of the many ways that we can use a fix flip tool. And as was evident in our meeting last night when we were discussing Christina's success, one of our senior MLO and team leaders, she is just hitting it out of the park with fix flip deals, because it's a nice niche. Very few loan professionals out there are partaking in fix flips. Everybody's trying to maintain in their comfort zone, but those that do venture outside of their comfort zone can really add a very lucrative additional stream, which for some may become the primary income stream of your business. Very little competition out there. So fixed flip deals are for investment properties only, whether it's ground up construction or whether it's a rehab, right? It's for investment properties only. If it's a primary or second home, it would probably be a ground up construction. So it's very important to differentiate between the two, because on the one-time close, that's for a primary or second home, there really is no investor experience, prior build out, building, construction, heavy rehab, or anything like that required. It is where you as the borrower would be qualified credit and income. The renovation has to get approved and the contractor has to get approved. So it's like a three-step process there. For one-time close, no experience is required from the borrower. The borrower is not going to be directly involved in the build. There's no selling of the property after the build. It's just they're building to live in it as a primary or second home. Whereas in the investment property, this fixed flip is pure investment. And that's very important, because in the ground up construction, income of the borrower is an essential component. You qualify credit and income, the renovation, and the contractor. In the fixed flip, this is where most MLOs have to adjust their mindset. The deal, it's basically, is there meat on the bones, right? How much profit is there in the deal? Because the investors, in this case, who are analyzing the eventual loan, right? Not the investor that is buying the property. They are going to analyze the profit margin, because that's what's going to, in their opinion, determine the successful flip, right? If there is a limited profit margin and any little hiccup occurs in the process, you've eaten your profit. And now what do? You're looking at somebody who's dragging their feet to finish it, because they're keep putting money into it and they're not going to make any money at the end. It's easy for them just to walk away, and the lender holding a half completed project, which is basically an empty bag. So that's why on the fixed flip, they will analyze not just credit, which is obviously a very important component always, because that's how you determine your habits to repay your debt. But they also look at the experience level of the flipper, right? And by experience level here, we're not talking about are they a contractor and have they built homes before. We're talking about their experience managing the project, their experience. They have to be an owner at the inception of the project when the asset, the raw product, let's call it that, is purchased. They have to be involved in the managing of the product of the project as one of the members of the LLC, and they have to be involved in the sale of the project as one of the members in the LLC. So they have to be involved all throughout the process from beginning to end, and that would constitute their experience. So the more flips, whether it be heavy rehab, ground up construction, or regular, that they have under their belt, the better the loan, the offer is going to be on this fixed flip loan. So there, with that being said, because that's really what one of the mistakes most MLOs new to fixed flip make, they'll say, "Oh yeah, my borrower has a partner, but the partner is the contractor that's going to build the home, and he's never managed a flip. He's just built 100 homes in his life, never been involved in a flip." That partner has no experience. So we do have fixed flips and ground up for borrowers with limited or no experience. But in the example that I'm going to share here with you today, it is a borrower with 5 flips in the last 3 years, experienced flipper, right? So in this scenario, it's a 12-month term, experienced investor with 5 flips in the last 3 years. And in this case, due to his experience and due to the profitability of the deal, the investor is going to be able to borrow 85% of the purchase price and is borrowing 100% of the rehab costs, right? So really good options here. But look at the breakdown in this deal, right? So you understand why it's such high LTVs. And these are numbers based on an actual deal, right? So you're looking at $400,000 purchase price. That's the as-is value. You're looking at $100,000 rehab budget. You're looking at an after repaired value of $700,000. So that's $200,000 in gross profit on that deal, right? So in the scenario, the borrower is going to be asked for $77,990 for down payment and closing costs. This is not a full itemization of the closing costs. This would be down payment plus all of the bank related fees. This doesn't include title fees or escrows or anything that may be applicable, but this is lender fees, down payment, the interest reserve, and anything else that's going to be calculated, liquidity buffer, what they're talking about there's like a little bit of extra money they need to show in the bank as reserves. Debt service, $36,000. So look at total. So it's $77,990, $66, and $36,112 for $120,702 to get into the deal. So if we go a little bit down here now, so I can show you all how cool this shows up here. So total cost $502,440, gross profit $197,560. And now here's where it gets really interesting on the numbers and where you're gonna wow the investors. And this is why, yes, the conventional loans right now are suffering a little bit of a hiccup, with rates, volatility, but non-QM and specifically fixed flip is really taking up the slack in the activity in the business, and most of the senior MLOs in the mortgage calculator will let you know, because they're getting a lot of these types of deals. Look at this. Okay, so he's getting 110% of the as-is value in the loan of $440,000, 87% loan to cost, 62.86% loan to value based on the ARV. This is why the deal is being able to get these high loan numbers, because the ARV is pretty good. So obviously you present this. Okay, the rate 10.24 also. So it's pretty good rate.
You
So
almost forgot the rate there.
what do you say? I'm sorry.
I said you almost forgot the rate.
Yeah,
Let's
yeah,
talk
I
about
know.
the. Let's
Well,
talk about the loan.
because everything else is so good.
Yeah.
This is how I present it, though. I mean, I the rate is an afterthought here. That's
Oh, yeah.
just it. Everything else is what they're going to look at. How much
Can
are
we-
you lending me? What's the
Can we
percent?
can we go over loan to cost real quick? So loan to cost and ARV, LTV, those are typically going to be our limits, right?
Correct.
So as Jose is explaining there, the as is LTV is typically irrelevant. Notice we're at 110. No loan programs out there are saying, hey, we'll loan 110 LTV, right? It's not the LTV that's going to limit these programs for our team out there. We're typically going to be at an 85 or 90 LTC. So can you highlight the LTC?
Right
Jose?
here, 87.57%.
So this program goes up to 90, but notice Jose's scenario didn't quite max it out. And it's every scenario is so different and all these numbers vary. Jose tried to max it, right? He tried to go as hard as he could to get the best meat on the bones, as you say, right? And it still didn't quite max, but it's very close. So he could only go a tad bit more on the LTC. And the ARV, we typically, most of our programs for fix and flip, so everybody knows out there, will typically max out at 75 or 70 on the ARV LTV. Can you scroll over that, Jose, real quick?
Right there.
So the ARV, after repair, for the final project, they're only going to go up to 75% of that of the end final project. And fortunately, in this case, there's so much meat on the bone, we're not hitting those limits either. So the limits we're hitting in this case, we're not hitting the LTC limit quite, and we're not quite hitting the ARV LTV limit, which are typically our restrictions there on the LTV. So Jose did a very good job of putting a valid scenario here together that's not quite going to hit our maxes and offer the maximum leverage for our borrower. So be very careful here when you guys are structuring these. There's multiple targets, not like a regular loan where we just have LTV, right? There's only one target, right? It's either, it's LTV for a primary home, right? It's LTV versus DTI. These are different targets, right? We got moving targets. There's no DTI, no income involved, but we have to hit these LTC, ARV, LTV. And then, of course, there is still going to be an as-is LTV max typically, which this program does allow you to go over 100%. Not everybody does, right? So you got to be careful there too. We're going to hit all those different limits. And that's why it's also very hard to quote these. We love to quote these, but make sure your investors that are asking you to quote these provide you all the information, right, Jose? If you don't know the budget, they can estimate it. But remember, that budget changes by 20 grand. This whole quote is going to be totally different, right? The budget changes by 20 grand just on this quote. He might hit the LTC and the ARV instantly and limit our final loan amount. So you got to be very careful when you put these together. But for the investors out there watching, please get us a full estimate and we can give you everything like Jose has here down to your profit margin and everything. And that's really what's going to attract the good rates and terms from our outlets, right? Our end investors that are buying the loan, right? So I just wanted to kind of go over that there, Jose. Well, let me
There's a couple of points I wanted to make regarding this type of a product. First of all, when you are pre-approving someone for a fix flip, you got to understand that it's deal specific. You can't just do like a TBD pre-approval for a fix flip, because at that point, all you're going to tell the borrower is, okay, your credit score is above the minimum required for this option. Your experience level is X, whatever it may be, 1, 2, 3, 4, 5 flips. So it's good. It's going to help you or hinder you, depending what may be applicable. But without a specific property, without a specific as is value, without a specific rehab budget amount, and without a specific ARV, we cannot really totally pre-approve the deal, because that's what we're doing. We're pre-approving the deal that the flipper is bringing us. So we need to know his experience, his credit, and the profit on the deal to be able to issue a pre-approval. And the profit on the deal, I want to touch on this also, will determine the rate just as much as the experience level will determine the rate. Less profit, higher risk in the loan to be finalized, higher rate, because risk is directly proportional to rate, or rate directly proportional to risk, I think is what I meant to say.
Beautiful. We're gone kind of long today, but this is a detailed topic, so I appreciate everybody sticking with us. Looks like we got everybody still tuned in. Let's go over a couple questions here, Jose. So obviously, I think you touched on this, but everybody's wondering the experience. Can you touch on the experience one more time for Matthew here?
Oh, yes, definitely. This is one of the most common missteps when we're sizing up a deal or thinking what's possible, is that we get the investor that may be a contractor and have built homes or renovated many homes, but never done a flip, where they actually own the project, manage the project, and were responsible for, buying, rehabbing, and selling it as a manager of the project, not as the renovator.
Yeah. Let me be specific, guys, since Matthew, you're one of our loan officers, right? What that means for us as loan officers is our investor, our client, needs to give us a HUD of them purchasing a property, right? A CD, a closing statement of them purchasing it, and a CD of them selling it with their name on it, right? Or their company's name. They have to purchase it, them personally, with their company name on the HUD. And then the selling HUD has to be for more, right? We're not going to give a failed flip as an example. So every time you're going to actually have to prove your client's experience history, remember, you're going to need a HUD from them purchasing and a HUD for them selling for more than what they purchased for and put into the project. That's a successful flip. So only projects with two HUDs that match and a budget in between that is profitable is a valid experience, right? You submit one that you lost money on, obviously that's not going to work very well, right? So make sure not only are their name on the HUD, but that the investor made money. If they lost money, obviously we're not going to, that's going to be a no-go, right? So make sure that they're on the HUD and they made money and we can prove it, right? That's what we have to do. But of course we have options for no experience, right? It's just going to be more expensive, less, more restrictive on the terms, right, Jose? More restrictive on the LTVs, right? The leverage. So we have options for sure.
Yeah.
Let's see. What?
Got a really good question there.
Yeah, this one. What do we do for a takeout here, Jose? What can a borrower do
Yeah. I mean, thank you for reminding us to talk about exit strategy. Yes, when we're getting, that's the beauty of the fixed flip, is that it's a pure consultative experience, right? You go into the fixed flip, and then the exit strategy is going to be either sell or hold, right? If you're going to sell it, you're selling it. If you're going to hold it, we're going to refinance you at the end of the flip, or when it's completed, at the completion of the renovation, we're going to refinance you into an end loan, which is usually, for most of the investors, usually going to be a DSCR, business purpose type loan, usually closing in an entity, which is our flagship product. So very easy transition. And that's something that you discuss at the onset of the project, not like, okay, I'm done, what do I do now? You want to give them the objective clearly when they begin.
So the takeout is always a DSCR, though, typically, right? We're always going to go DSCR for Levine. That's the go-to. Of course, they can sell it and be a fix and flip, but fix and hold, it's always a good exit strategy. We can always provide that. Ben here, Jose, asking, what about the appraisal process? Can you go over the appraisal again?
Sure, I did touch briefly on that. The appraisal on a fixed flip is an ARV appraisal, right? So basically, it's a regular appraisal that has a couple of additional components. So the appraiser is going to need to know the scope of the work. So, right? So the appraiser is going to determine the as-is value of the collateral. Then they're going to analyze the scope of the work that was provided by the borrower and or the loan officer, right? That has to get uploaded into the portal when you do the appraisal request. And then the appraiser is going to then determine, based on as-is property and renovation work, they're going to then determine an after repaired value, also known as ARV. ARV is an acronym for after repaired value. So very different. Very different. You can't go and say, "Oh yeah, I'm going to transfer an appraisal for this property" if it's not an ARV type appraisal. So it is a very specific appraisal, and many times there are specific procedures that have to be followed for each program. So I do encourage MLOs to coordinate very closely the appraisal ordering process on these fixed flip loans.
And keep in mind, it's a more expensive appraisal, right? Every time you have multiple aspects of the appraisal, it's going to increase. So I would expect typically, just for our investors out there that are, thinking of doing a fix and flip, just expect to pay about, double or close to double what the regular appraisal would be if it was just a regular long-term appraisal, right? They are complicated, and you do have to provide a scope. And typically, Ben, if you do order it, the scope is going to determine the cost, right? So I just ordered one the other day. It was only like $200 more because the scope was only about $30,000, right? Very small scope. But if that scope was $300,000, you could bet that appraiser was going to quote me instead of $750, more like $1,500, right? If it was a big scope, ground up build, whatever it's going to be. So keep in mind your scope is going to affect the price of the appraisal, and always expect to pay a little bit more. I think that's it for our fix and flip questions. There was a couple other questions, but it has to do with other stuff. But we've gone quite a bit over here. We appreciate all the questions, guys. You know where to find us. Our emails are here. But Kyle, why don't you go ahead and close us out for today?
Yeah, absolutely. Yeah, thank you everybody for tuning in. Great programs there. If you want to proceed with one of these programs, get with one of our loan officers. We have 350 loan officers all across the country, licensed in 22 states. And then these fix and flip loans we can do in almost every state. So if one of our loan officers maybe shared this video with you, that's great. They can get you one of these quotes. If not, you can visit us at themortgagecalculator.com, and we can pair you up with one of our loan consultants. As Jose said, this is a consulting process, right? And at the Mortgage Calculator, our loan officers do not only just do conventional FHA, VA, USDA, but we do all the non-QM products from the bank statements and the DSCR all the way to the commercial and the fix and flip like we just went over today. So get with us. We will connect you with one of our loan officers who can consult you through the process of whatever it is you're trying to do. We do this show every day at 11 a.m. Eastern time, so you can tune in and see how the rates fluctuate. I'm sure they'll be different tomorrow than they were today. So tune in, and we will see you tomorrow at 11 a.m. Eastern. Thank you, everybody. Have a great day.